At exactly 9:47 a.m. Beijing time on December 15th, 2025, something unprecedented occurred in the basement vaults of the People's Bank of China. Not a financial transaction, not a policy announcement, not a diplomatic negotiation. The systematic physical movement of 1,147 tons of gold bullion from storage facilities, designated for international settlement, to vaults, marked Strategic National Reserve, indefinite hold. The largest single-day gold reclassification in monetary history, conducted in absolute secrecy, representing the opening move in a coordinated assault on the 80-year-old Bretton Woods system that had made the US dollar the foundation of global commerce. The timing was surgical. American markets closed for the weekend. European financial centers preparing for holiday schedules. Asian trading dominated by routine year-end portfolio adjustments. But in the secure communication networks connecting central banks across Beijing, Moscow, Mumbai, Brasilia, and Pretoria, a different kind of coordination was reaching its final implementation phase. The BRICS nations weren't just discussing de-dollarization anymore, they were executing it. What made December 15th different from decades of previous discussions about alternative reserve currencies was not rhetoric or intention, it was mathematics. The 5 original BRICS members, Brazil, Russia, India, China, and South Africa, had reached combined economic mass sufficient to challenge dollar hegemony through coordinated action rather than gradual erosion. Their collective GDP exceeded $26 trillion. Their combined trade volume approached $8.5 trillion annually. Their coordinated foreign exchange reserves totaled $4.7 trillion. More significantly, they controlled resources and supply chains that made their economic statistics translate into genuine leverage over global commerce. China dominated rare earth processing, lithium refining, and semiconductor manufacturing. Russia controlled natural gas distribution and grain exports. India managed pharmaceutical production and information technology services. Brazil commanded soybean markets and iron ore supplies. South Africa provided platinum and other critical minerals essential for industrial production. But the December 15th operation wasn't just about economic statistics or resource control. It was about creating an alternative financial architecture that could function independently of dollar-dominated institutions. The movement of Chinese gold reserves represented the final accumulation phase of a strategy that had been building for 8 years through incremental steps designed to avoid triggering coordinated Western responses. The strategy had begun in 2018, when Chinese officials started requiring increasing percentages of international transactions to be settled in yuan rather than dollars. Initially, the requirements applied only to Belt and Road infrastructure projects where Chinese funding provided leverage over partner countries. Gradually, the yuan settlement requirements expanded to include energy purchases, commodity trades, and technology transfers. By 2025, approximately 31% of Chinese international trade was conducted in yuan, compared to 11% in 2018. Russian contribution to de-dollarization had accelerated dramatically after 2022 sanctions removed Russian banks from SWIFT systems and froze dollar-denominated reserves. Rather than attempting to restore access to Western financial networks, Russian officials had focused on building alternative systems that bypassed dollar requirements entirely. The SPFS, System for Transfer of Financial Messages, became the foundation for ruble-based trade with China, India, and other non-Western partners. The key breakthrough had occurred in March 2025, when Russia and China established the first major commodity exchange that priced oil, natural gas, and metals in a basket of BRICS currencies rather than dollars. The exchange initially handled approximately $340 million in daily trading volume, but that number had grown to $2.8 billion by December 2025. More significantly, the exchange had proven that major commodity transactions could be settled efficiently without dollar conversion or Western banking intermediation. India's participation had been crucial for establishing the credibility of non-dollar payment systems among developing countries that represented the fastest growing segments of global trade. Indian officials had negotiated rupee-based trade agreements with 23 countries, including major partners like Russia for energy imports and UAE for services exports. The success of these bilateral arrangements demonstrated that countries could reduce dollar dependence without sacrificing trade volumes or economic growth. Brazil's role had focused on agricultural commodities and regional financial integration across Latin America. Brazilian officials had established the Brazilian Real Digital, CBDC, as an alternative to dollar-denominated agricultural financing, enabling farmers across South America to access credit and market their products without dollar conversion requirements. The system had processed over $145 billion in agricultural transactions during 2025, representing a 340% increase from previous years. South Africa had contributed through its position in African financial networks and its control over strategic minerals, essential for renewable energy and technology production. South African officials had negotiated mineral supply agreements that required payment in a combination of rand, yuan, and gold rather than dollars. These agreements covered platinum, palladium, and manganese exports that were essential for automotive and technology manufacturing globally. But the individual contributions of BRICS members were less significant than their coordinated implementation of alternative financial infrastructure. The December 15th operation represented the culmination of 3 years of technical development that had created functional alternatives to dollar-dominated systems for international payments, trade finance, and reserve currency functions. The BRICS payment system had evolved from theoretical framework to operational reality through systematic testing and expansion. Initial tests in 2023 had involved small-scale transactions between Chinese and Russian energy companies. The system had gradually expanded to include Indian pharmaceutical exports, Brazilian agricultural sales, and South African mineral trades. By December 2025, the BRICS payment network was processing over $47 billion in monthly cross-border transactions. More importantly, the system had demonstrated reliability during periods of stress that had disrupted dollar-based payment networks. When Western sanctions had complicated payments for Russian energy exports, the BRICS system had provided seamless alternatives. When Chinese technology companies had faced restrictions on dollar-based financing, yuan-denominated credit had maintained their operational capabilities. When Indian companies had encountered difficulties with Western banking relationships, rupee-based trade finance had preserved their international business activities. The technical architecture underlying BRICS financial integration represented sophisticated innovation that addressed traditional obstacles to non-dollar international commerce. Historical challenges to alternative reserve currencies had included limited convertibility, insufficient liquidity, and lack of institutional infrastructure for complex financial operations. The BRICS system had solved these problems through distributed architecture rather than centralized institutions. Rather than creating a single BRICS currency that would require complex political negotiations about monetary policy and exchange rate management, BRICS officials had developed a basket-based system that allowed each member to maintain domestic monetary sovereignty while participating in coordinated international settlements. Transactions were denominated in special drawing right-style units that represented weighted averages of member currencies, but actual settlements occurred through bilateral arrangements between member central banks. The system's liquidity had been established through systematic accumulation of member currency reserves by each BRICS central bank. China held substantial reserves of rubles, rupees, reals, and rand. Russia maintained yuan and rupee reserves sufficient to support energy trade settlements. India accumulated yuan and real reserves for technology and agricultural purchases. The cross-holdings created a web of financial relationships that enabled efficient currency exchange without dollar intermediation. Perhaps most critically, the BRICS system had developed institutional infrastructure for trade finance, letters of credit, and complex financial instruments that had previously required access to Western banking systems. The BRICS Development Bank had expanded beyond infrastructure financing to provide trade credit, currency hedging, and investment banking services for member countries and their trading partners. The December 15th gold movement represented the final element needed to establish the BRICS system as a genuine alternative to dollar-based international finance. The accumulated gold reserves provided backing for the basket currency system that enhanced credibility among potential users, who remained skeptical of pure fiat currency alternatives. More immediately, the gold reserves enabled BRICS central banks to offer gold-backed trade credits that appealed to countries seeking alternatives to dollar-denominated financing. But the strategic implications of December 15th extended far beyond technical financial arrangements. The operation represented a coordinated challenge to American economic hegemony that threatened the foundations of post-World War II international order. The dollar's role as primary reserve currency provided the United States with extraordinary privileges that had sustained American global influence even as relative economic power declined. Dollar hegemony enabled the United States to finance government deficits through foreign purchases of Treasury securities. International demand for dollars allowed American consumers to purchase imports with currency that cost nothing to produce. The dollar's role in international transactions provided American financial institutions with intermediation opportunities that generated substantial profits while creating dependencies among foreign users. More significantly, dollar dominance provided the United States with sanctions capabilities that had become central to American foreign policy strategy. The ability to exclude countries or companies from dollar-based financial systems created powerful incentives for compliance with American policy preferences. The threat of financial isolation had proven more effective than military pressure for modifying the behavior of adversaries and allies alike. The BRICS alternative threatened to eliminate these advantages by providing functional substitutes for dollar-based systems. Countries that gained access to BRICS payment networks would no longer depend on American financial institutions for international transactions. Companies that could finance trade through BRICS mechanisms would become less vulnerable to American sanctions pressure. Central banks that held BRICS currency reserves would reduce their exposure to American monetary policy decisions. The immediate market impact of the December 15th operation became visible when Asian financial markets opened on December 16th. The dollar index fell 2.8% in the first hour of trading, as currency traders recognized the implications of coordinated BRICS action. Gold prices jumped 4.3% as investors anticipated increased demand for non-fiat store value assets. Oil prices rose 6.1% as energy markets priced in the possibility of reduced dollar pricing for petroleum transactions. But the longer-term implications were far more significant than single-day market movements. Intelligence assessments suggested that the BRICS operation had been coordinated with similar initiatives by other countries seeking to reduce dollar dependence. Turkey had announced plans to settle energy imports in lira and yuan rather than dollars. Saudi Arabia was reportedly negotiating yuan-denominated oil sales to China that would bypass traditional dollar pricing mechanisms. Malaysia and Thailand were discussing regional currency arrangements that would reduce dollar usage in Southeast Asian trade. The accumulating momentum represented a tipping point in global monetary arrangements that American officials had long feared but struggled to prevent. Traditional tools for defending dollar hegemony assumed that challenges would come from individual countries that could be isolated through economic pressure or military intimidation. The BRICS coordination involved too many large economies across multiple regions to be contained through conventional American responses. Economic retaliation against BRICS members would damage American interests more than target countries. China was the largest holder of U.S. Treasury securities and the most important trading partner for American multinational corporations. Russia controlled energy supplies essential for European allies and maintained military capabilities that could complicate American strategic objectives. India represented the fastest growing major economy and a crucial partner for countering Chinese regional influence. Military pressure was even less feasible against a coordinated group that included nuclear powers with substantial conventional capabilities distributed across multiple continents. The BRICS challenge couldn't be addressed through the kind of regime change operations that had been applied to smaller countries with weaker institutional capabilities. The Federal Reserve faced particular constraints in responding to BRICS de-dollarization efforts. Traditional monetary policy tools assumed that dollar demand would remain relatively stable, regardless of interest rate adjustments. If significant portions of international trade shifted to alternative currencies, dollar demand could decline even during periods of high U.S. interest rates. The relationship between American monetary policy and international capital flows could break down if BRICS alternatives provided sufficient liquidity for global commerce. More immediately, reduced international dollar demand would complicate Federal Reserve efforts to manage domestic inflation and employment objectives. Higher interest rates needed to control inflation could become ineffective if international dollar demand declined. Lower rates needed to support employment could trigger capital flight if investors anticipated further erosion of dollar purchasing power. The Fed could lose control over domestic monetary conditions if international currency shifts undermine traditional policy transmission mechanisms. Treasury officials confronted even more direct challenges as foreign central banks reduced their holdings of U.S. government securities. International purchases of Treasury debt had enabled the federal government to finance deficits at relatively low interest rates, despite accumulating debt levels that exceeded 100% of GDP. If foreign demand for treasuries declined significantly, the government would face higher borrowing costs that could make fiscal policy unsustainable. The mathematics were straightforward and terrifying. Foreign official institutions held approximately $7.7 trillion in U.S. Treasury securities as of late 2025. If BRICS de-dollarization efforts encouraged even 20% of foreign Treasury holdings to be shifted into alternative reserves, the U.S. government would need to find an additional $1.5 trillion in domestic financing for existing debt. The required increase in interest payments could add $400 billion annually to federal deficits, depending on prevailing rates. Congressional response to the BRICS challenge revealed the political constraints that limited American policy options. Republicans focused on military solutions that were impractical against nuclear powers with substantial conventional capabilities. Democrats emphasized diplomatic engagement that assumed BRICS members shared American interests in maintaining stable international monetary arrangements. Neither approach addressed the fundamental reality that BRICS countries were pursuing policies that served their national interests rather than global stability. The disconnect between political rhetoric and policy reality reflected deeper problems with American strategic planning that had become apparent across multiple domains during the 2020s. American officials had become accustomed to international systems that privileged American interests, but lacked strategies for operating in environments where other countries possessed viable alternatives to American-dominated institutions. The BRICS de-dollarization effort represented the international monetary equivalent of challenges that American policymakers were confronting in technology, trade, and security domains. Chinese technological capabilities had eliminated American monopolies in telecommunications, artificial intelligence, and renewable energy. Russian military capabilities had demonstrated that American conventional superiority was not sufficient for achieving political objectives in contested regions. The accumulated challenges suggested systemic erosion of American hegemony rather than temporary setbacks in specific policy areas. International financial markets began pricing this systemic erosion through currency adjustments that accelerated during late December 2025 and early January 2026. The dollar index continued declining despite Federal Reserve intervention efforts. Gold reached record highs as investors sought alternatives to fiat currencies. Commodity prices rose across multiple sectors as traders anticipated reduced dollar pricing for international transactions. More significantly, credit markets began reflecting increased risks associated with dollar-denominated assets. Yields on long-term Treasury securities rose faster than short-term rates, suggesting investor concerns about long-term dollar purchasing power. Corporate bonds issued by companies with significant international exposure faced higher borrowing costs as markets priced currency risks that hadn't been relevant during periods of undisputed dollar hegemony. The emerging credit pressures threatened to trigger broader financial instability that could accelerate de-dollarization trends through self-reinforcing cycles. Higher borrowing costs for dollar-denominated debt would encourage companies and governments to seek financing in alternative currencies. Increased use of non-dollar financing would reduce demand for dollars, further weakening the currency and raising borrowing costs. The spiral could continue until dollar-based financial systems became prohibitively expensive relative to alternatives. American financial institutions faced particular vulnerabilities during this transition period. Major banks had built international operations around their privileged access to dollar funding and their role as intermediaries for dollar-based transactions. Reduced international dollar usage would eliminate fee income from correspondent banking, trade finance, and foreign exchange services that had generated substantial profits for decades. More immediately, banks with significant international exposure faced credit risks if borrowers couldn't access dollars needed for debt service. Emerging market companies that had borrowed in dollars during periods of low U.S. interest rates could face severe stress if dollar appreciation continued while their revenue remained denominated in weaker local currencies. The resulting defaults could create losses for American banks similar to those experienced during previous emerging market crises. But the December 15th operation had created conditions that differed fundamentally from previous episodes of dollar strength and emerging market stress. Historical crises had occurred when developing countries lacked alternatives to dollar-based financing and were forced to accept International Monetary Fund conditionality that required policy adjustments favoring American interests. The BRICS system provided alternatives that could allow countries to avoid both dollar dependence and Western policy constraints. Countries facing dollar-denominated debt stress could potentially refinance through BRICS institutions rather than seeking IMF assistance. Companies needing international credit could access yuan, rupee, or other BRICS currency financing rather than paying premium rates for dollars. The availability of alternatives could prevent the kind of capitulation to Western pressure that had characterized previous financial crises in developing regions. Countries that gained access to alternative financial systems would have greater autonomy in foreign policy decisions that previously required consideration of potential American economic retaliation. European allies who had supported American sanctions policies, despite economic costs, could reconsider their positions if BRICS alternatives provided access to markets and financing that compensated for lost American relationships. Middle Eastern countries that had aligned with American regional strategies could pursue more independent policies if Chinese and Russian partnerships offered comparable security and economic benefits. The accumulating shifts suggested the possibility of rapid transformation in international political relationships that could leave the United States isolated despite its continued military and economic capabilities. American hegemony had been based on the absence of alternatives to American-dominated systems rather than purely on American strength relative to potential competitors. The creation of functional alternatives could trigger alliance realignments that would fundamentally alter global strategic dynamics. Intelligence assessments warned that the pace of change could accelerate beyond American ability to develop effective responses. The BRICS operation had demonstrated that coordinated action by multiple major economies could challenge American dominance more effectively than individual competitors. Other countries observing the success of BRICS de-dollarization might join similar efforts, creating momentum that would be extremely difficult to reverse. The December 15th gold movement represented more than a financial operation. It represented the beginning of the end for the monetary system that had sustained American global leadership since World War II. The 147 tons of gold that disappeared into Chinese strategic reserves carried with them the foundations of 80 years of American economic hegemony. The Bretton Woods system hadn't collapsed from external attack or internal contradiction. It was being systematically dismantled by countries that had built alternatives and acquired the economic mass necessary to make those alternatives viable. The dollar's reign as the global reserve currency was ending not with dramatic crisis, but through the quiet accumulation of gold in basement vaults and the patient construction of parallel financial networks. The new monetary order emerging from BRICS coordination would not replace American dominance with Chinese hegemony or Russian control. It would create a multipolar system where multiple currencies and institutions competed for international usage. The result would be more complex, more fragmented, and far more difficult for any single country to dominate. American officials were discovering that monetary hegemony, like other forms of power, couldn't be preserved through force when alternatives became available. The countries that had built those alternatives were now implementing them with the systematic patience that had characterized their broader challenge to American global leadership. The age of the dollar was ending. The age of monetary multipolarity had begun. And the transition was accelerating faster than anyone in Washington had anticipated.